Greetings, children. Welcome to my channel, Inside Accountancy by Shakun. Accounting made easy for you all. Today, we'll be talking about financial statements of a company, which is the first chapter of Part B of your TS Grewal, that is, Analysis of Financial Statements. So, let's start. In this video, we'll be talking about the meaning of financial statements, the financial statements of a company, what they comprise of, the characteristics and nature of financial statements, and the limitations of financial statements. Okay, so what are financial statements? Financial statements provide a summary of accounts of a business enterprise. The balance sheet reflecting the assets, liabilities, and capital as on a certain date, and the income statement showing the results and operations during a certain period. This is the definition given by John N. Meyer. So, financial statements are the final product of the accounting process. They are prepared following the accounting principles, the practices, the accounting standards. So, by following all these practices, we carry out the accounting process and then we prepare the financial statements, which comprise, as you can see in this definition, which comprise of the balance sheet, which reflects the assets, liabilities, and capital, and the income statement, which you commonly refer to as the profit and loss account. So, financial statements involves the preparation of balance sheet and income statement, which gives us an idea about our assets, liabilities, owner's equity, that is the capital, the revenues and the expenses, which are the elements of financial statements. Section 129 of the Companies Act 2013, it prescribes that balance sheet and profit and loss account, the statement of profit and loss, are prepared in the form which is prescribed in the Schedule 3 of Companies Act 2013. So, as per the Section 240 of the Companies Act 2013, a set of financial statements which are to be prepared by any company, it includes the balance sheet, profit and loss account. The balance sheet is the position statement, as you commonly know. It gives us the statement of assets, liabilities, and equity of the company on any particular date. It shows the financial position of the business by listing the various elements such as assets, liabilities, and capital. Profit and loss account, as you used to prepare in case of sole proprietorship. In case of company, we call it the income statement, or we call it the statement of profit and loss account. The statement, sorry, not account. When we use the word statement, we don't use the word account. So, this is the statement of profit and loss, which gives us an idea about the financial performance of the business, that is, the result of the business operations. We also prepare the notes to accounts. Notes to accounts are nothing but they are the ones which support the balance sheet as well as the statement of P&L. So basically, the balance sheet and statement of P&L, they are supported by notes to account, which gives us the details of items which are given in the balance sheet as well as statement of P&L. So basically, as per the Companies Act 2013, as per the Part 2, Schedule 3, the face of the balance sheet and statement of P&L should always remain the same for every company. So there is a specific format that is given by in the Companies Act, and that is the format which should be used by all the companies. Now, there may be changes in the various elements. Those changes can be shown in the notes to accounts. So, notes to accounts is a supporting document which supports balance sheet and P&L and gives us the details of the various items. Then, the financial statement also includes the cash flow statement. Now, cash flow statement is prepared according to the Accounting Standard 3, and it shows the various inflows and the outflows of cash and cash equivalents. So the various sources from which cash is coming in and the various applications to which cash is applied is shown in the cash flow statement. So please remember the section as per section 240 40 of the Companies Act 2013, the financial statements involves the preparation of the balance sheet, the profit and loss statement. So the statement of profit and loss, not the account. I've written account here because the balance sheet prescribes it in this format. But we do not write account in case of company. We use the word statement. Then it involves the preparation of notes to accounts, and finally the cash flow statement. Now, let's talk about the characteristics of financial statements. The first characteristic is that it is a historical document. Why is it a historical document? Because it relates to the past period. The information or the transactions relating to the past are recorded in the business and they are reflected in the financial statements. The second one is monetary terms. So whatever transactions are recorded in the financial statements, they are expressed in terms of money. That is why this is another characteristic of financial statement. It always is in monetary terms. Qualitative transactions are not shown in the financial statements. Financial position and performance. So from the financial statements, we come to know about the financial position of a company with the help of preparing balance sheet, and we also come to know about the financial performance in terms of the operations by preparing the statement of P&L. So balance sheet and statement of profit and loss is prepared to know about the financial position and the financial performance of a concern. So these are the characteristics of financial statements, that it relates to past period, therefore it's a historical document expressed in terms of money and depicts the financial position and performance. Now, let's talk about the characteristics separately of a balance sheet as well as of a income statement, that is a statement of P&L. So, in case of balance sheet, as you know, balance sheet depicts the financial position in terms that is depicted on a particular date, on a particular point of time, financial position of a business at a particular point of time, and the two parts of the balance sheet should always match. That is, the assets should always be equal to the total of liabilities and capital, which is the basic accounting equation also. The balance sheet shows us the various balances of assets, liabilities, and capital respectively. The accounts in the balance sheet, they may have an opening balance. Then various transactions during the year may be recorded as well as the closing balance. So these are the characteristics of a balance sheet. Coming to the characteristics of a statement of P&L. Statement of P&L tells us about the financial performance of the business, of the company in terms of revenue, expenses, profit or loss, etc. relating to the business operations. It is a historical document because it relates to the transactions of the past period. And it is prepared for a specific accounting period, like we prepare for 12 months ending 31st of March. So it is prepared for a specific accounting period. So this was all about the characteristics of balance sheet and the statement of P&L. Now let's talk about the nature of financial statements. The first one is recorded facts. The term recorded facts, it means that the recorded transactions in the books of account, the transactions are recorded in the books of accounts on the basis of evidences. Any transaction just like that cannot be recorded in the books of accounts. Only when a transaction is supported by documentary evidences, vouchers, etc. will it be recorded in the books of accounts. For example, the amount of cash in hand, cash at bank, debtors, sales, purchases, etc. These all are recorded facts because they are based on documentary evidences. The second nature is accounting conventions. Now, the various transactions that are recorded in the books of accounts, they are recorded on the basis of certain accounting concepts and conventions. For example, you very well know the convention of prudence or the convention of conservatism, where we should anticipate all prospective losses, but we should not make an accounting for any prospective profits. So in accounting, while recording the closing stock, it is always recorded at the market price or the cost price, whichever is lower. So while recording the transactions in the books of accounts, the accounting conventions, etc., they must be taken into consideration. the use of accounting concepts and conventions, it makes these statements very reliable, understandable, and comparable. And it shows a better financial position. The next nature is accounting concepts. Now, as you have studied in chapter 2, there are certain conventions and concepts that must be followed by an accountant while recording the transactions in the books of accounts. For example, the going concern concept. Now, under this concept, it is assumed that the business will be continued for a foreseeable indefinite period of time. Now, fixed assets are shown in the balance sheet at their historical value rather than the market value. Now, the use of these accounting concepts, it also makes these financial statements reliable, understandable, and comparable. So, the accounting concepts which are there, they are followed while recording any transaction in the books of account. Now, there are certain accounting standards which are mandatory in nature because they are the guidelines which must be followed while preparing the financial statements. Now, all these guidelines, all these standards, they must be followed by the companies. If they are not followed, then the financial statements will not show a clear and fair and true view. The next one is accounting policies. Now, which accounting policy a company chooses, it has a great impact on the financial statements. For example, which method of charging depreciation is chosen by the company, it will have a bearing on the financial performance and position. For example, whether the company chooses the written down value method or the straight line method will have an impact on the financial performance and on the financial position, because it is going to impact the statement of P&L also, and it will impact the balance sheet also. So these policies also should be properly selected because they have a bearing on the financial position and performance. The next one is estimates. Now, when we are preparing the financial statements, we have to make certain estimates, and those estimates, they have a bearing on these financial statements. For example, useful life of a fixed asset is estimated to provide for depreciation. There is one method of charging depreciation, that is the straight line method. Under that, we assume or we make an estimate of the useful life, that is the number of years for which the asset is going to be useful for us. And on the basis of that, the depreciation is calculated. So it also involves the preparation of financial statements. It also involves making certain estimates which do have a bearing on these financial statements. Very important source of financial information. These financial statements are a very important source of financial information because on the basis of these, the conclusions can be drawn about the profitability and the financial position of a company. This information may be used by the management, by the owners, the shareholders, the creditors, the investors, the government, the research agencies, etc. So all these various internal and external users, they are in need of the financial information which is provided through the financial statements. So this was all about the nature of financial statements. Now let's talk about the limitations of financial statements. The first limitation of financial statement is historical records. Now, financial statements, as we understood while learning about the characteristics also, that they are based on past data. They are based on historical data, right? So these financial statements which are based on past or historical data, while the parties which are interested in the information, such as the investors, shareholders, management, etc., they are more interested in knowing the present position and the future prospects of the concern. For example, an investor who wants to invest in a company would like to know that what is the company doing, how is the company doing at present, and what are the future prospects, right? So since the financial statements are based on historical data, so it loses its relevance sometimes. Second is affected by estimates. Since we told you that in the nature also we discussed that in financial statements we have to make certain estimates. So financial statements are the outcome of accounting concepts and conventions which are combined with certain estimates that are made by the accountants. Stock valuation method, provision for depreciation, etc. All these methods of charging depreciation or valuation of stock, they are based on certain estimates. Therefore, we cannot say that all the financial statements are, always free from any kind of bias or prejudice. The next one is accounting practices. So there are different accounting practices. The financial statements can be drawn up on the basis of different accounting practices. For example, depreciation may be provided through either of the two methods which are there, which you have studied in class 11. That is either the straight line method or the written down value method. Now the profit earned or the loss which is incurred will be different as per the different practice. So if we are following different accounting practices, our financial statements will give a different picture about the performance as well as position. Qualitative elements. The qualitative elements are ignored because the financial statement provides only the financial information and it does not show any qualitative elements such as the quality of management, the working conditions, public relations, etc. So only those transactions which can be expressed in monetary terms, only those transactions are recorded in financial statements. The qualitative aspects, howsoever important they may be, they are not recorded in the books of accounts. The next one is price level changes are ignored. Now, different assets that you are recording in the balance sheet, they are based on historical cost concept. So, financial statements, therefore, they ignore the price level changes or the present value of the assets. Hence, they do not reflect the current market position because the assets, they are recorded at the cost at which they were purchased, not at their current market values. The last limitation is the purpose of all parties not met. Now, there are a number of parties who are interested in the financial statements. That is, there are a lot of people who are interested, and their interest may also be, it may vary depending upon person to person. So, therefore, financial statements, they cannot meet the purpose of all the interested parties, all the parties who are interested in that financial information. Their interest may not be satisfied or fulfilled by the preparation of only the financial statements. So these were the few limitations of financial statements. Moving on, in this video, we have talked about the meaning of financial statements, that these financial statements are very important as they show us or they give us a better view of the financial performance as well as the financial position. We also talked about the financial statements which involve the preparation of balance sheet, the statement of P&L, and the cash flow statement as well as the notes to accounts, the characteristics and nature of financial statements as well as the limitations of financial statements. I hope the concepts were clear to you. If you have any questions, you can contact me on my email ID. Please like, share and subscribe to my channel. In case you have any a thing that you want to put up, you can comment, you can leave a comment in the comment section. So this is Inside Accountancy by Shakun signing off, waiting for your comments. Thank you so much.